Hey guys, JC Peretz here, and welcome back to the podcast. I am joined today by Jeff Hirsch, author of the Stock Traders Almanac. Jeff and I we've been going back and forth about seasonality and technical analysis for as long as I can remember. I have been reading the Stock Traders Almanac every year as long as I can remember. I have old copies that go back 15 years, and I know Jeff has some old copies that go back almost 50 years. So we're gonna get into market cycles, the annual cycle, the presidential cycle, and all kinds of seasonal trends that we need to know as investors. So without further ado, ladies and gentlemen, my conversation with Jeff Hirsch, author of the Stock Traders Almanac. How's it going, my man?
All right, buddy. How you doing?
Dude, you slinging NFTs or what?
Me?
Yeah.
No.
What's the seasonality on the NFTs? How does that work?
I don't even think it exists yet. It doesn't. Don't you need at least a year for a seasonality?
Dude, where's the NFT Traders Almanac? That's what I want to know.
I don't even know what an NFT is. I guess we're making one right now, though, probably.
Are we making an NFT? Is this podcast an NFT? Is that what's going on?
Couldn't it be, if I understand the concept correctly?
Listen, if you want to make this podcast an NFT, I will call somebody who can probably do that. Oh, Jeffrey, good to see you, man. How you been? Everything good?
Yeah. We're making changes. We're rearranging things here.
Well, don't make too many changes. I like the almanac. I just received it.
We're actually refocusing even more on the almanac, and probably going to be doing more with the newsletter as well.
Very cool. No, yeah. Listen, I love it. You put out great work. For those of you in the audience who don't know, Jeff Hirsch, author of the annual Stock Traders Almanac, must read. Every trader or investor who takes their portfolio seriously should have the Stock Traders Almanac on their desk. Is that not true there, Jeffrey?
It is. And I'll tell you something. We had a nice article come up from the Bloomberg about the super boom forecast we made back in 2010. And I forwarded it to a friend who was a pit trader, big S&P CBOE trader back in the day. Ran one of the biggest desks. I think the biggest S&P futures desk out there. Used to trade. I think he still trades for Marty the Pitbull Schwartz, Danny Riley, Mr. Top Step. He's got a service as well. And he was telling, this reporter, because I said the article, that when he was trading back in the day, he didn't know anything about seasonalities. And then Marty Schwartz gave him the almanac. Schwartz's book was our best book way back in the day, and was also dedicated as one of the top traders, So he said Marty turned him on to the book 28 years ago and said, you need to have this on your desk. You need to incorporate this in your trading, and it will. And he's done it ever since. And now he and I are friends. So, coming from a guy, that was a floor trader, old school pit trader, didn't know about seasonals, been using them for, better part of 3 decades to success. So I concur. You're right.
I figured you would there, Jeff. All right, so why don't we talk a little bit about seasonality? From my perspective, I like to know how the market tends to do during a particular time of the year or a particular cycle. And what really catches my attention is that when the market ignores those seasonal trends. So if the stock market's supposed to go up and it does, great. The stock market's supposed to go down and it does, great, right? Nothing really to write home about there. It's when stocks tend to do well, when stocks do well when they shouldn't. Like, for example, before the Trump election, stocks in general did very well during what is historically the worst 6 months of the year, which is May through October. And stocks did well. And November, December, January, stocks ripped after the election. But the seasonals were already giving us a heads up. Same thing, when stocks are supposed to do well and they don't. The best 3-month period of the year just started November through January. If stocks don't do well in that environment, probably doesn't look too good moving forward when they're supposed to go down. So that's how I look at that. Do you think that that's a good way to approach seasonality?
That's one of the ways. I mean, you and I have spoken about this before. If it's not a trading strategy, if you're not using it for trading and it doesn't work, it's definitely it becomes an indicator.
Right.
And usually a contrary one. I mean, the Santa Claus rally in and of itself, everyone makes a big fuss over, oh, this is the Santa Claus rally starting on Thanksgiving or Halloween or whatever, but it's really a seasonal indicator that last, 5 days, first 2 days of the new year, it's usually up. You got the pros in there buying up stocks that are sold for tax loss selling. And if it doesn't go up, it's a sign that something's amiss with the market.
And then hold on, just be clear, because some people, think they understand the Santa Claus rally, but specifically it's the last 5 trading days of the calendar year and the first 2 in January, correct? 7 days.
Correct. Page
7 trading days.
116 this year? No, that's the free lunch.
So talk to me about the free lunch. I love it when you talk about that. Tell the folks about the free lunch.
Well, it's a catchy headline. Hat tip to the old guy, Yale, who I just saw for his 98th birthday.
Is my copy actually signed by Yale, or is that somebody else signing for him?
Did you actually not realize that when you posted the picture? Yeah.
That's a real Yale Hirsch signature?
Yes. He
sick.
I woke him up from his wheelchair nap while they were cleaning his room, and I said, "Here, sign these $25." And you, my friend, are one of the few people that gets one.
Wow, dude, that means a lot, man. He's a legend, and so he has good handwriting. The old man.
What's that?
His handwriting is very impressive.
Better than mine, right?
Better than mine too.
I'm horrible. Phil Perlman got one signed too.
I was just talking to Jay Woods, and I was like, "Hey, I got Jeff Hirsch on the podcast. What should I ask him?" He's like, "Ask him where my copy is."
He's got to be man enough to come to ask me himself.
That's what I told him. He's like, "How'd you get one?" I was like, "I was busting his chops, and I got one in the mail the next day."
Exactly. Well, I mean, it's not just that you busted my chops. You
always send it to me.
You use it, man. I
do use it. I love it. I think it's fantastic. I got it. Looking at it right here.
Free lunch.
Free lunch. Talk to me.
Yale, great with words, could always coin a phrase. I mean, the Santa Claus rally, if Santa Claus should fail to call, bears may come to Broad and Wall, that's him, all that stuff. But it really is more free, if you allow that, when the market's down significantly going into it. 2019, not so great. 2020, that was great. But 2018, when we had that little correction there, and I'm just going to flip through.
The correction that started in October in the fourth quarter?
Yeah, if you have a nice sell-off prior to that, it makes the strategy much better. If you look, at the 18 to 19 on page 116, you can see we had a really nice pop. Last 2 years weren't good at all because the market was way up. You need to have, and the pickings were super slim last year, and Chris and I were just like, well.
So walk the folks specifically what we're looking for the free lunch.
Looking for stocks making new 52-week lows on triple witching Friday before Christmas in December to make a nice bounce between, during the Santa Claus rally and also help get a little January effect with small caps doing well.
And you're only buying the ones making new 52-week lows.
And we're only buying the ones that are only straight up, regular equity shares, not preferreds, funny warrants or closed-end funds or.
And then on triple witching, because why? Because they're just puking out whatever's left?
There's a couple of reasons. One, selfish. It's a Friday before the weekend. Gives us a little time with the market closed to run through the stuff, a little weekend activity, so you don't have the goalposts moving. The volatility and volume from triple witching as well.
Yep.
And it's right ahead of the Santa Claus rally. And the thing is, the old days, it used to be December 15th to February 15th, stocks making new lows on a NYSE outperformed the composite index itself. But with the modern trading times, we've seen that shift a little bit towards the end of the year, where tax loss selling continues a little bit longer. And we've got, faster trading, electronic trading, and all that kind of stuff. So it shifted a little bit later in the month, over the years. Also, we don't take every single stock making new 52-week lows. It's the ones that they have to be trading for a year, no new issues, no splits, no special, nothing, just straight up regular common shares that have been trading for a full year. And then, if there's a big
the Russell
lift,
3000, what's the universe?
It's the NASDAQ, the NYSE, and Amex.
Got it.
Occasionally, we'll go look at the bulletin board if we need to find some.
How many names usually come up, you think? Last year was slim pickings, you said?
Yeah, there were new lows. No lows. Usually, a dozen.
We were in the middle of the best 52-week period of all time, so there were.
I mean, up 75% year-over-year on March 23rd or whatever. Nothing works 100. As I joke nowadays, nothing works 100% of the time. I don't work 100% of the time. JC doesn't work 100% of the time. I'm sure you have a couple of family activities that you might do that aren't working.
Yeah, 60% of the time it works every time.
Yeah, exactly. We'll take 60%.
Listen, we're entering November right now. The seasonals and all the indicators really start piling up in December. I want to get into that. But as we're starting November, this is the best 3-month period of the year, November through January, and we just finished the worst 6-month period of the year, which is sell in May and go away and come back on St. Ledger's Day. Right? And what is it? Buy in October and get yourself sober.
That's my line.
That's your line, right? I give you props for that one. Buy in October, get yourself sober, or you have to remember to buy in November.
That's you, right?
Right? There's a whole bunch of them. The fact that stocks did so well. I mean, stocks, when you look at the indexes, even small caps, transports, S&P, NASDAQ, they all were up during market period that they're supposed to go down.
Not as much as the previous year. The NASDAQ and the Qs, the NDX 100 is the best 8 months and the worst 4 months. And over the worst 4 months, NASDAQ did not do so well at all. It was about flat. I think we ended up being a little bit down with our technical overlay. We're looking at using the MACD to get in and out of these things a little bit early. So not as great as last year, where we had a really, solid worst 6 months. So, things started clicking in September and October. Right. Everyone thinks October is the worst month. It's not. It's got a history of crashes and massacres and all that stuff, but it's become a lot better.
What's the worst one, September or February?
September's the worst month of the year.
September's the worst month. And what's the best month, November?
Depends on the index. April for the Dow and S&P, it's tied with April and November for, it's a fractional decimal point.
November's a big one though, right?
November's also the important part about November is the small caps. This is where the small caps kick.
The January effect starts in November now. Is that what's going on?
You look at the chart on page 114. Look at your book. You can see it. There's like almost a double bottom, a little rise. Higher lows. Almost, if it were a chart, that's a comparison of the Russell 1 in 2000, and yeah, it almost begins around Halloween.
Isn't this called the January effect? Wasn't this supposed to be in January?
It was the old January effect. There was an old paper that was done by Sidney Wachtel, old investment banker from the 40s. And, small caps used to outperform large caps in January. But January in and of itself is weakening. It's become a bit more of a profit-taking period. That old January break that Danny taught me about in the S&Ps has become a little bit stronger. We're seeing January weakening over the years.
So what does that say for the January barometer, which is different than the January effect? The January barometer is the January effect is that small caps outperform large caps at this point, starting around Halloween versus January. But I love how we still call it the January effect. Should be the October effect. And then the January barometer is as January goes, so goes the rest of the year. But you're telling me that January is not as strong as it used to be. What does that say for the barometer?
It says that we've built on it. We've stood on it. On its shoulders, and we've added in January indicator trifecta, which is a combination of the Santa Claus rally, the first 5 days early warning system indicator, and the full month January barometer. And the numbers there are more compelling than the barometer itself. We keep track of these things. You can't throw an indicator, into the graveyard until you've had enough years where it's not working. But more of the major errors have occurred in recent years, so it's definitely something we got our eye on. And
it's interesting how you do that. I like how you do that. So you got the Santa Claus rally. So if Santa should fail to call, the Bears will come to Broad and Wall. Was that your dad or was that Stovall?
It was my father.
Stovall takes all the credit.
He's like you. He gives us props. He's a good
guy. Yeah. So talk to me about the first 5 days. You just kind of like breeze through that. That's a big deal. So first 5 trading days of the year.
It's kind of like a mini, it's always been it was an old thing, the first week of January. It's one of those old indicators people looked at that we've tracked for years. It's got some pretty decent predictive power, but not as good as the full month barometer. And none of them are as good as the three combined, what we've seen over the years, especially when they're all three positive. It's like, out of 30, I think it's like up 27 to 31, occurrences since 1950, if memory serves.
What's your favorite seasonal study?
Oh, I like to buy in October. I like the
good one.
I like the signal. I mean, it's probably the one that's got the best solid history, and some of the other ones, and what we've learned over the years is things rhyme. It's not exact. Like they shift a little bit. We look for clusters of days and where the market moves in a certain way. And you can miss by a day. You can have the Fed make an announcement. And you can have some COVID news or who knows, Janet Yellen or Biden, somebody does something that knocks that day off. But the best and worst months, you've got a period of time where it allows the market to fulfill that seasonal bias, that seasonal tendency, instead of just, trading it each and every day. And on top of all this stuff, what we've also learned is that, like you, my technical friend, we overlay the technicals and fundamentals, unlike you, with the seasonalities. I know you're not a big fan of fundamentals because it's all in the numbers, but when we look for stocks, we do our screen for stocks that are below Wall Street's radar, not being followed by a lot of people, but kicking out good numbers, acceleration of revenue and earnings growth, good valuations. But we also look at them technically on the charts, and we get into them at the seasonal right time of year. So we just put out our basket a couple of weeks ago with some stocks that got through those screens, and then we get in there using the technicals with the buy limits and that stuff. So you got a little smirk on there. What do you?
No, listen, you're welcome to do anything you'd like to do. For me, I just don't see the sense in diluting something as perfect and factual as price with something as arbitrary as an earnings estimate. It's just, not for me. I like how you
I don't do estimates.
You like to look for underfollowed names, right? We like to do that as well.
That are making money and accelerating.
Yeah, I don't care whether they're making money or not, though. I like the fact that they're underfollowed. That I'll give you that one. I like the seasonals. And at the end of the day, you're looking for stocks that are doing well. Stocks making, right?
Yeah, but not quite recognized yet. Not taken off, not lagging the market, not leading the market, so it's not earnings estimates. I just want numbers, like money, and we're big revenue people. Like price to sales is the first thing I learned to do in stock analysis, because that's hardest to manipulate.
Yeah, I hear that a lot. Straza says that a lot internally. So I'll give you that. What about like commodities and stuff like that? There used to be a commodity traders almanac. What happened to that one?
Well, we still use it in the newsletter service. We still track those seasonals, but in the book business, if you got to sell a good amount of them to make it worth your while. And it's a lot of research, a lot of effort going into making that book, because instead of dealing with one market or 5 indexes in the stock market, you got anywhere from 20 to more, complexes using. You got different contracts, different monthly contracts. So it's a lot more data to put
What's
together.
your favorite seasonal study on the commodity side?
Copper.
Talk to me about copper seasonals.
You've been talking about copper a bit later. It's December to May. It's been an effective trade for us when it sets up technically.
Isn't that part of just like seasonal strength in stocks? It's kind of, doesn't it like fit in with that, right? Because if copper's doing well, stocks could.
It's not, November to April. It's more like December to May. It overlaps, but it has to do with the construction. It's also the new car, coming in there, which we've got supply chain issues there. But it's just been a good trade, and we use some stocks like Freeport, or there's some ETFs out there. We used to have a great stock that tracked that seasonality well, but they got taken private. It was Global Brass and Copper Holdings. The ticker used to be BRSS. And they were using like scrap metal basically, and some Swiss metal or jewelry company took them over or something like that. I think it was Swiss or whatever, somebody in Europe. But
what's a seasonal study that you think people don't give enough credit to or don't pay enough attention to?
Most of them. I think it gets poo-pooed enough that it keeps it. If everyone believed it, it probably wouldn't work anymore.
And then what about, which one do you think gets too much hype?
It's sell in May. I mean, it's like, it's not about sell in May. It doesn't say sell in May. It's like the market kind of goes sideways during the Q2, Q3.
Right.
It's a time to be a little patient, tighten up stops. We reposition in May through July, which is like where the best 6 months ends and the best 8 months for NASDAQ and the Russell's end. And we get rid of losers, tighten up stops, get rid of underperformers, and we switch over into some more of the defensive sectors. Utilities does well in the March through October period, the sort of worst 6 months period. Staples.
The dollar weakens during the best time for stocks. That makes sense.
Bonds, not that there's much there to do, but if you're looking to make that seasonal trade has worked well for people. It's not something you do with everything, but your IRA, your retirement account, you take a portion of it and you trade it out of the Qs, the Russells, the diamonds, the spiders, whatever ones you like. We recommend all 4 in the newsletter. I just picked up the Qs and the IWMs after our MACD buy last month, so I'm kind of happy with that trade right now.
Oh yeah, small caps are ripping, breaking out of an 8-month base or something like that.
They hit a new high today, right?
Yep.
Yeah. So we're happy with that. And I'll stick to our own, our own recommendations when we do the monthly analysis, wherever our stop is. If it goes through a stop, we don't usually keep a stop on the seasonals, but once we get into May, on the tactical seasonal switching strategy, the best months, when we get our first Dow and S&P sell signal, sometime after April 1, we'll probably put a little stop in there on the Russell. So it depends how high up it goes. Last year it got stopped out, but it was like a 28 or something or whatever, 23, 4, 5% gain. I forget exactly what it was.
Do we have enough years now to have a Bitcoin seasonality? It kind of looks like stock seasonality.
Yeah, right? It does. I talked to Phil about that. It's a little bit short on data for me. It's getting there. I mean, I don't like anything less than 21 years.
Why 21? Fibonacci number?
Because it's an odd number and it's like 2 decades, and you don't get any 50%. It's an old Yale trick. But it's the 20 years is what you look at. But we had 21, so we can get actual something discerning. So you don't have up 10, down 10.
Man, the NFT Traders Almanac. Coming to an NFT trading desk near you.
We've been talking to some people about bringing the Commodity Traders Almanac back or something there. But,
bring it back. I loved it. It was a different color. I get 2 of them each year. It's fantastic.
Well, we should talk. I was talking to folks at the Money Show about that. They were expressing some interest. We've tried to do an app for the Almanac, but it's
a commodities bull market. I don't know if you heard. Wheat breaking out, cotton breaking out, oil making new 7-year highs, CRB index, everything but gold.
I think we do better with it using the seasonals in a newsletter. I just putting a book together for that. It's just not worth the time and effort and money. We're still all over those strategies.
And then what about, so Jeff, talk to me about like some of the other intra-period seasonality within a given month, seasonality within a given week or day.
Well, let's look at November, December, since we're there. You see that weakness in the beginning of December. Before that, we got the Thanksgiving trade coming up. We like to think it's better to come into Thanksgiving week long on weakness and get out by like Friday. Beginning of December, weakness, the first bunch of days tends to be a little bit flatter. Little tax loss selling picking up there or winding down. And then you got the end of the year. So, those are the periods. But the best 3 months are important. You want to watch for some of that February weakness around President's Day going in.
Buy that February dip, though, right?
If you're trading it that frequently, if you're going to do that swing trade, yeah, look for that February weakness and jump on, because March is usually pretty strong and April's usually a strong month.
Another reason why Halloween, like of the fake holidays, Halloween is way better than Valentine's Day, and the seasonals tell you that too. Halloween you get to dress up, kids love it,
and you can play golf on Valentine's Day. I mean, on Halloween. Valentine's Day you can't play golf. It's usually pretty cold around here.
Yeah, you gotta buy stocks on Halloween. That's the trade.
Probably earlier. Whenever MACD gives you the crossover, I think whenever the 817.9, we start looking for that technical trigger after October 1. And I think that's something that has got to, be music to your ears. Using, you can use whatever technical trigger you want or analysis. You could stack up your indicators, but one simple technical indicator is better than that. I mean, when I do my chart, for most people, there's too much crap on there. Not like
for me, less is more.
Helene, Helene Meisler, right? She does like one line. It's like, she's great. I look at different things and, I don't know. Everyone's got their style.
All good, Jeff. Let's talk presidential cycle. Mm-hmm. So here we are. We're finishing the post-election year.
Yeah.
And we got the midterm year coming up.
Midterm year has been the one that's maintained its sort of weaker status, whereas the post-election year has gotten stronger over the years. In conjunction with the midterm years, we say where bottom pickers find paradise, is the headline. It sort of dovetails with what's going on. I mean, the election yesterday, Democrats pretty much across the board, it got a little message, got kind of shellacked a bit. Not surprising considering what's going on, but that's what feeds into the midterm pattern of weakness. Is you've got a current president, especially a new one here, who's being judged, and they usually disappoint because they can't fulfill all their promises.
Right.
Biden's having more trouble than some right now with their agenda, the pull from the more progressive liberal end of the wing of the party. And in addition to that, as you were saying before, we had the best 52 weeks of all time, ending on March with the up 75% at the March 23 anniversary of the pandemic low there. And with that, we're looking at some reversion to the mean with the rolling 1-year periods and rolling 10-year periods. We looked at, put some of that stuff out in the blog. And then you throw in the political, mudslinging that tends to happen in the midterm year. And the fact that the comps year over year are going to get a little weaker, are going to be a little bit tougher, because last year, this time, we were just coming out of a pandemic and there was like negative spending going on out there in some instances. So combined with the political climate that's bound to heat up a bit next year, I think that sort of dampens stock prices. I don't think, we're going to have a best 6 months like we had last year, but I think we'll have a more normal average one in the, 7, 8, 9%. NASDAQ's up, 8% or something since our buy signal. And, that's almost half of the full best 8 months trade there. So it's probably going to be a little more modest going forward.
When it comes to the presidential cycle, the first couple of years, like you said, it's impossible for the president to be able to deliver on all the campaign promises. So there's just like that hangover and disappointment going into the midterm year. Isn't there a certain element of like they want to take care of all the bad stuff and all the negative stuff so that the last 2 years of the cycle, it's all rah and positive things leading up to the election? So the first 2 years of the presidential cycle were less so. And then the last 2 years, so then we're talking 2023 and 2024.
However,
would be more positive. Is that the deal?
However, the election year, 2024 election years have become less positive. It's become a battleground. The constant campaigning, much like the stuff that happens in the midterm year, it takes a toll on the market. We've had some. So the fourth year is becoming.
So the election year is becoming less positive, and then the first year, which is the post-election year, is becoming less negative. That's what's been happening?
Right, but the third year, still the most powerful.
Third year is the best one. Pre-election year.
Pre-election year, still solid. Midterm year, still that great, place. So the weak spot of the 4-year cycle is Q2 and Q3 of the midterm year, which is next year, 2022, like April.
So during it's the worst 6 months of the year, and it's the worst 2 quarters of the presidential cycle at the same time.
Correct, sir.
So that's gotta suck.
And what do you think that sets up?
Well, it sets up a ripper after that.
Right. It's called the sweet spot.
Right.
Which is featured on a page in the Almanac nearby where we're looking. And that's Q4 midterm through Q2 pre-election year. And even through the whole pre-election year is just that's the strength. You want to buy that Q2, Q3 low in the midterm year. Sometimes, we'll get it when we get a best 6 months buy signal in October. The Dow there's this gain from the midterm low to the pre-election year high. Dow averages just under 50% from the midterm low to the pre-election year high. NASDAQ, 70%, 70.
How do you feel about the decennial cycle? It seems a little bit odd, but it tends to work.
Not all of it. I mean, 0 years and 5th years. I mean, it's something we continue to track, but not a huge impact for us.
The fifth years always did well until everybody caught on, and then in 2015, everybody was talking about it, right?
Yeah, and the 0 years have been negative. So other than that, it's been inconsistent, and I don't really subscribe to it without, just to be totally candid about it.
Right. No, I love it, Jeff. Listen, you tell it like it is. You're the the authority on the subject. Shout out Yale Hirsch, legend. Who are some of Yale's inspirations?
I mean, Sam Kozlow, his cousin that brought him into the business, who I named my first son after, Samson Kozlow. He was a songwriter and a producer in Hollywood, but also
a seasonal trader.
Well, investor, and he didn't do the seasonals per se, but he started a publication called Indicator Digest back in the 60s, and he brought my father into work for him, and that's where Yale was, running operations and publishing and also doing research, and that's where he saw all these indicators in the seasonals and said, let's put all this stuff together in a calendar format so we can follow the market's calendar along with our own. That's when he went out on his own and started the Stock Traders Almanac. So
what year did he start? What was the first year?
He incorporated in 66 while my mom was pregnant with me. And then
that was the top of the market, right? So Yale Hirsch starts the Almanac, and the market doesn't go higher for another.
He didn't release the first edition until the fall of 67. He really cramped, did like 18 months of research putting the thing together. I mean, we were looking at pencil and paper and adding machines and graph paper and, Barron's paper lab pages and stuff, which is how I learned how to do the calculations in the beginning.
You still do it that way, Jeff?
No. I still have the adding machine, chops with the fingers sometimes. That clicks back in. I use the numpad on the keyboard, but no,
that's hilarious.
We have a piece of software that we can query anything we want, pretty much.
Is Yale jealous that you get to do it way easier than he used to have to?
He wants to know when he's having lunch, is what he wants.
That's my man right there.
And he's like, I weigh 240 now? It's like, yeah, Pop. He's like, no, I don't. Bring in a scale. He doesn't remember what's going on so much.
Dude, tell him that JC Peretz is a huge fan of his. Obviously, I'm a huge fan of yours. I love having these conversations. The markets aren't going anywhere, Jeff. I don't plan on going anywhere. You're going to be around for a long time. We will continue to have these conversations about seasonality. I always enjoy it. And next time I see you in Las Vegas or New York, cocktails on me.
Or the Poconos.
Or whatever. I don't care. Let's go get some beverages, man.
Sure, man. I always look forward to hanging out with you, man.
Oh, yeah. Good times. Always. Jeff, thank you so much. And everybody out there listening, go to stocktradersalmanac.com, right? Follow the Almanac Trader on Twitter, Jeff Hirsch, and get the Almanac. If you don't have the Almanac, what are you doing? What are you even doing? Where did your life go wrong if you don't have the Almanac? Right, Jeff?
Wholeheartedly agree.
Check out
All right, buddy. All right,
Talk
man.
soon. Hey, guys, thanks for listening to the podcast. To catch up on all prior episodes, go to allstarcharts.com/podcast.